I hope you're doing good. Thank you for sparing the time to watch this video. In one of my recent posts on LinkedIn, I said investment managers should be bold enough to take sectoral calls, to which someone came and said, no, it is highly risky to invest in sectors, and few others said, of course, why not, if the investor's risk profile allows you to do so. So I thought in this video, I would talk about why sectoral investing is good for investors and what are the ways in which you can either over-allocate or under-allocate to a sector that is in favor or out of favor as per you. This is a good video for both investment managers and also DIY investors. Let's get started. So if you see the short-term trends, the monthly moves of sectors, you can very clearly see that the 6 sectors that I've analyzed, like auto, banks, FMCG, IT, metals and pharma, none of them show a clear pattern. There are new winners each and every time. But the moment you go to a cumulative growth, you can see that there are clear trends. For example, in this case, metal has been leading the rally right from May 2020, while FMCG has been very badly languishing behind. Metals has given over 300% return, while FMCG has given only 25% return since the COVID crash. As you all know, sectors or sectoral play last for more than 18 months or 24 months or 36 months. So I thought, why don't I show you a longer term chart? And if you see over 3 years, IT has been a clear winner, right? While metals has still given 140 or 150% return. You can see that auto has been very badly languishing at about 105% return, or in the sense it's given 5% return, absolute return over the last 3 years or so. And that's the whole reason why I believe that it is not just important to enter into a good sector, but it is equally important to understand and identify when one should exit a sector also. So for example, if you take COVID situation in place, both metals and auto were down from 100% to close to 30%, which is like a 70% loss. Unbelievable. But then metals have significantly recovered, and that's the reason why metals are showing 154% as against auto, which is stuck at 105%. Please choose your sectors wisely and exit even more wisely. People say it is risky. It is, by looking at metals volatility. But the moment you see FMCG's volatility, which is only at about 6%, while Nifty is at about 13%, right? So there are also sectors which are lesser volatile than your broader market. So blindly saying that all sectoral investing is risky isn't really true, right? Okay, you are now sold into sectoral investing. How do you build portfolios? Do you bet on one or multiple sectors? You can do both. For example, let us say there are 2 funds. For this analysis, I've looked at large and mid cap as a mutual fund segment. In the first, you can see that the fund has invested, or the fund manager has invested about 20-21% in financials, while the second fund has got 30% in financials, right? So if you're positive on financials, go ahead and buy this. The other thing interesting is that this fund manager is bullish on construction, which you don't see in many mutual funds. For example, here, this fund manager is only 3%, while this fund manager has got about 11% invested in construction. So if you're very bullish on construction and financials are okay to invest in, then this is a fund to look at. Here, bullish on economic recovery, while here he has been playing more on defensive like healthcare and technology. So it is up to you now either to choose this fund or the other fund. Now this may also end up being very fruitful for you, because if these 2 sectors turn out to be good for you, whether it is construction or engineering or financials, this fund can actually beat most of the category managers or category funds, right? This is one of the ways in which you should screen, or your investment manager should screen, the mutual fund holdings. What are the other ways? So for example, if you have built a portfolio which is low on banking, you can straight away go and buy a sectoral banking fund, a technology fund, or a FMCG fund, depending on your view on these sectors. If you're bullish on a certain theme, saying infrastructure because of the spending around the union government, you may go and buy infrastructure funds. I am a strong believer that consumption will be back in a big way, in the next 2-3 years. So I will go and invest in consumption based or thematic funds. The sixth option is called a sector rotation small case, which happened in August because I was looking for a fund that was high on metals and I couldn't find any. At max, there was one fund that had about 8.5% invested in metals. I wanted about 30% allocation. That's when I spoke to someone and they designed a small case which will rotate their money in various sectors which are undervalued. I'll attach the link to the sector rotation small case in my comment section. So you can now clearly see that sector or thematic funds are good to add provided you do your research around which sectors to buy, and when to exit. I hope you found this video useful. Thank you.